You walk into a bank and deposit $1,000. The teller smiles. Your account updates. The money is yours. Except it isn't there. Not really. If everyone with money in that bank showed up tomorrow morning and asked for their cash back, the bank wouldn't have it. Not even close. This isn't a conspiracy. It's not a glitch. It's the design. Let's start with something simple. You give the bank $1,000. You think of it like a vault, a safe. Your money sitting there, waiting for you. But banks don't work like vaults. They work like engines. The moment your money arrives, it starts moving. Not all of it, but most of it. Here's the reality. Banks only keep a small portion of your deposit immediately available as cash. The exact amount isn't fixed anymore, but most of your money is still put to work. That means if you deposit $1,000, the bank keeps a fraction ready. And the rest? Gone. Lent out, invested, put to work. You still see $1,000 in your account, but most of it exists somewhere else now. In someone's mortgage, in a small business loan, in a line of credit for a car dealership 3 states over. This system is often explained using something called fractional reserve banking, and it's been the backbone of the modern financial system for over a century. Now here's where it gets strange. That money the bank just lent out, it doesn't disappear from the economy. Let's say the bank gives it to someone as a business loan. That person deposits it into their account, maybe at a different bank, maybe the same one. Doesn't matter, because now that bank keeps only a portion available and lends out most of the rest again. Someone borrows that, deposits it. Another bank keeps a portion, lends out the rest. Your original $1,000 can now support several $1,000s worth of bank deposits in the system, not through printing, not through magic, through repetition. This process is often described as the money multiplier effect, and it's why economists say banks don't just store money, they help expand the money supply. You might be thinking, that sounds unstable. You'd be right. The whole system runs on one fragile assumption, that not everyone will want their money at the same time, because if they do, the machine breaks. This has a name. It's called a bank run. It's happened before, many times. In 1930, during the Great Depression, over 9,000 American banks failed, not because they were criminals, not because they made bad bets, because people got scared. They showed up, they asked for their money, and the money wasn't there. The banks had lent it out, like they were designed to do. But when everyone wants cash at once, there's no time to call in the loans, no time to sell the assets. The system freezes. So how do banks get away with this? 2 reasons. First, regulation. After the Depression, governments created rules, deposit insurance, central banks, requirements for how much capital and liquidity a bank has to hold. In the U.S., the FDIC insures deposits to $250,000 per account, so even if your bank fails, you get your money back, courtesy of the government, which means courtesy of taxpayers. Second reason, trust. As long as people believe the system works, it works. The money doesn't need to physically exist, it just needs to exist on paper, on screens, in ledgers and databases, and apps that update in real time. You believe you have $1,000, so you do, until you don't. Let's talk about what banks do with your money while it's out there in the wild. They lend it, yes, but not randomly. Mortgages are the big one. In the U.S., mortgages make up a large portion of bank assets. Think about that. A major part of the banking system is tied to people's homes. This is fine when home values go up. Everyone wins. You build equity. The bank profits. The economy grows. But when home values drop, the math flips. People owe more than their house is worth. They default. The bank forecloses. The asset they thought was worth $400,000 is now worth $250,000. Multiply that across millions of homes, and you get 2008.
Banks also invest in bonds, government debt, corporate debt. They trade securities, complex financial instruments with names like collateralized loan obligations and mortgage-backed securities. Some of this is relatively safe. A lot of it isn't. And here's the kicker. They're doing all of this using money that originally came from depositors. You didn't agree to invest in subprime mortgages. You didn't sign off on a hedge fund strategy. You just wanted a checking account. Now let's zoom out. Banks make money in two main ways. One, the spread. They pay you maybe 0.5% interest on your savings account, then they lend that money out at 5%, 6%, sometimes more. The difference is profit. Two, fees. Overdraft fees, ATM fees, account maintenance fees, wire transfer fees. In recent years, U.S. banks have collected billions of dollars annually in overdraft and related fees alone. That's billions of dollars from people who didn't have enough money in their account, the people who can least afford it. Here's the uncomfortable question nobody likes to ask. If banks help create money by lending and they profit from the spread, and they're protected by government insurance when things go wrong, who's taking the real risk? Not just the bank. When banks fail in a systemic crisis, they may receive government support. The term is too big to fail. It means the bank is so central to the economy that letting it collapse would cause more damage than saving it. So the government steps in with public money. In 2008, the U.S. government committed hundreds of billions of dollars to stabilize the financial system. The banks survived. Meanwhile, millions of people lost their homes, their savings, their jobs. Let's bring this back to you. Right now, your money is in a bank, maybe several banks. It's being lent out, invested, leveraged. You're earning a fraction of a percent in interest, while the bank is earning multiples of that on the other end. You take on the risk of inflation eating into your savings. The bank takes on risk too, but in extreme cases, the system is designed to protect the banking system as a whole. This isn't to say banks are evil. They provide a service. They enable commerce. They make it possible to buy homes, start businesses, build infrastructure. But the system isn't neutral, and it isn't designed primarily around protecting small depositors. So what happens next? Some people say crypto will replace banks, decentralized finance, no middlemen. Maybe. But decentralized systems have their own risks, no insurance, no regulation, no one to call when things break. Others say we need stricter rules, higher capital requirements, break up the big banks. Maybe. But every time regulators try, the banks lobby back, hard. The truth is, modern banking isn't going anywhere. It's too embedded, too useful, too profitable. And most people don't even know how it really works. Here's the final thing to sit with. You probably checked your bank account today, saw a number, felt secure. But that number isn't money sitting in a vault with your name on it. It's a promise. A promise that when you need it, it'll be there. And most of the time, it is. But the system only works because most of the time is good enough, until it isn't. So the next time you deposit money, just remember, the bank isn't keeping it in a vault for you. The bank is putting it to work. And whether you benefit from that work depends on which side of the system you're on.
Disclaimer. This video is for educational and informational purposes only. It simplifies complex banking and financial systems for general understanding. It is not financial advice. Banking regulations and practices vary by country and change over time.